All right, what's going on, everybody? Welcome back to the channel. It's Millennial Trade. So we're going to talk about the market. I'm just going to kind of go through my little update here, everything that I'm looking at and what I did today. Today, I was in a trade on PayPal, and this trade was it wasn't that exciting to watch, but obviously we're up in the account. I talked about this on Instagram. But there were so many things. It looked so good for a long, right? Because you had PayPal's daily candle in demand. We were in a major demand area where a few months earlier, there was this huge surge in price around the area that we're in now. And so I was like, well, I'm going to go long on PayPal. Unfortunately, the trade, even though it worked out, PayPal wasn't able to break certain levels today, even though the market, the NASDAQ and the SPY are both up. Not by a whole lot, but, you've got the NASDAQ up like 1.1%. SPY isn't even up a whole percentage point, right? I'm looking at the futures here. But, and earlier today, you just had you had the dollar kind of trying to surge. You had the bond prices completely collapsing. And so when I was in this trade on PayPal, I'm watching all this go down because it looks so good for a long. And PayPal just got real choppy. So I took my, I took my call options off at, I think it was like 9:51. So I was out of the trade by 10 o'clock, which is great because then I can go to the gym. I can upload to social media and do everything else that I want to do with my life. This is why we're trading. This is why I'm trading, because so I have more time to do other things that are important to me. So the trade was a little sketchy. I went in way too heavy. I'll admit that. I had way too many contracts. But as I shared on my shorts on Instagram or on my reels, I was up almost $400 today. And, it's like a 14% gain in the account, or what was in the account this morning. So, trying to make money. Now, as far as holding these stocks and everything, I'm looking at my dividend portfolio here. Things are not terrible. We're down 10%, 10.27% in the dividend portfolio. And I'm holding like Ally Bank, Barrick Gold, Intel, Kroger, MPW. I even got Black & Decker in there, AT&T, Verizon. And I think I've got all my dividends except from Intel. I'm still waiting for dividends from Intel. So that's what I'm holding in the long-term account. Even though the NASDAQ did well today, I think some of the tech might have done well. Let me just look at here. Apple was up. Let's see. Was Google up? Google went up today. Let's see. Amazon. No, Amazon crashed pretty hard today, which is okay. That's fine. I like Amazon at these lower prices anyways. I'm waiting for all these tech stocks to hit like $80, $70, and then I'll be interested in, putting on a couple of shares. Fintech, unfortunately, just could not rally. You had Square. Square was up at one point in time pretty substantially. It's up. All right, well, Square's up 4% on the day, right? That's not a bad gain, but SoFi literally closed at the same price it was at yesterday. Okay, so we made absolutely no gains, no losses in SoFi, and PayPal was only up. These stocks gapped up a little bit too, I think. So you got to take that into account. The fintech was already up. That's why we don't see these. If you go and look at the charts, they look weaker, but they had already gapped up on the daily. So that's kind of how the trading day went. I don't sit here and watch these things all day long. Like I said, I try to get out by like 10, 11 o'clock. And I've been being really good about that. Am I leaving some money on the table? Yeah, but you got to leave money on the table if you're going to keep anything long term. That's been my experience. So Wall Street trades higher. You also had the German stock market earlier today, at least. The European stock indexes, all of them rebounding on Monday, led by travel shares. You got a bunch of earnings coming out from Germany, Adidas, Bayer, AstraZeneca. You guys know these names. So that's sort of what's going on the other side of the pond. While the German market and the U.S. markets were going up, the yield on the German bond, it's called the Bund, the 10-year Bund yield, continued to rise towards 2.3%. And this is like, these are 11-year highs that we're talking about here. So I mentioned this in a market update short that I did this morning because, when I see these bonds, it doesn't matter what country they're in. If bond yields are going up or at certain highs, breaking certain levels, it's important to pay attention to that because that can have an effect on the debt markets in, the country that we're in, maybe the country you're trading from. And it can affect the markets you might be trading as well. So that's why I mentioned it. I've been trying to get more into following bonds. I even made an account with our government. It's like a government treasury website where you can buy the bonds directly from the government. But I was thinking about, I was thinking about maybe even shorting bonds using TLT puts or something like that. Like going into December, it's probably a little maybe early to put that trade on because we want to see what the inflation data looks like. I think that might come out on the 10th. I think it's the CPI numbers. Another trade idea, right, that I've seen a lot of people talk about is VIX calls. If you go and look at the VIX options chain, there's a ton of calls for next week, like thousands of them, people holding this stuff. Some of them are way out the money. Some of them are like $75 or the VIX at 75, but some of them are like at 35 or whatever, a lot of them. So people are betting on volatility. And that's what happens with the elections. They tend to be kind of binary events. There's either going to be one or one outcome or another. But another thing really here is that you have there's a mix in the commodities market, which I don't really like. I want to know that commodities are going down in general if I'm going to be like bullish about the stock market. And the other thing is the Fed's decision in December, okay? That's really going to depend, like whatever the Fed does, 75 basis points, 50 basis points, there's a lot of people that are speculating the Fed's going to pivot or slow down these rate hikes. But if inflation, as the Cleveland Fed said today, if inflation comes in much higher than any of the estimates that are out there right now for the CPI data, it could be bad. It could be bad because the Fed, if the inflation is worse, okay, and hasn't slowed down, the Fed is going to have to continue this aggressive rate hike policy, which is most likely going to shock the markets. And when people say don't fight the Fed, I mean, this is what they're talking about. You follow what the Fed is doing. They haven't really given a lot of dovish, forward guidance here. So we just have to wait for these numbers to come out. But with the commodities, right, you have like coffee futures are down. They're at their lowest level in 15 months. You also have coal futures dipping below the 350 per ton mark. And that's a level not seen since early May, and it's down more than 20% from the September. So, you've got like coal in a technical bear market at this point, which I thought was kind of interesting. But if you follow oil and lumber, even natural gas, I had a story here about natural gas futures jumping up 10%, okay, hovering at levels not seen since early October. With the gas, you've got the combination of higher domestic demand, here in the United States, and falling output as well, which is not good at all. In Europe, okay, their natural gas situation right now, their prices came down a little bit, but there hasn't been a lot of demand to heat these homes in Europe because they're under kind of like a warm spell right now. It's unseasonably warm in Europe. What happens when Europe's in the dead of winter? You've got energy issues over there. We might have energy issues over here. We definitely have, the output issues that are mentioned all the time. So, are commodities generally trending down, or are we going to see them generally trending up? I mean, lumber futures or lumber, the price of lumber pulled back a lot, like for months now, and in October it ticked up a little bit. But this is sometimes how these contractions happen. You see them tick up again a little bit and sort of make these lower highs, and then they contract. But we really want to see the prices of commodities, if oil and natural gas and lumber and gold and silver, if all this stuff starts rising, it's not going to be good for the markets, and it's going to contribute to the inflation issues, and it's just not good. It's not good at all. And then you had Eurozone construction data. The PMI in Europe declined to 44.9 in October from 45.3 the previous month, September. So this is the sixth consecutive monthly contraction in construction output in Europe. So Europe's not doing well. Obviously, there's a lot of problems in Europe. I won't get into it in this video, but it's not looking good. And China imports year over year. This is important. Imports to China unexpectedly dropped about 0.7% year over year. All right. Compared with market estimates, it was supposed to be like 0.1%. And you've got, domestic demand weakening with these COVID lockdowns, because China is still sort of practicing these no tolerance COVID lockdown policies. And it's causing problems. I've been hearing a lot about this too, that, all of this failing state of the global economy might actually be due more to the supply chain restrictions because of the COVID lockdowns, not just the lockdowns that are going on now in China, but the effects from the lockdowns that even the West put in place back in 2020 and 2021. I mean, it took us like a couple years to really get out of this, and, economy started opening back up again, but it's the state of the economy, or the failing economy, might not actually be due to inflation or the ever-increasing money supply or the debt markets, the stock market collapse, all this kind of stuff. What if it's the supply chain and the deliberate, deliberate shutdown of these supply chains to try to, like in China, for instance, they're basically cutting back on manufacturing. Could we get to a point in the United States where, because we're this consumer-based economy, and we don't produce enough, we need to produce more? I mean, Elon Musk says this all the time. We need to be producing more here. But could we get to a point in America where we see huge shortages simply because these cheap goods that we take advantage of are just not being, produced to the extent that they used to be? Some people are calling for that. All right. And then the last thing I really wanted to mention here, because we've got the inflation report coming out, the CPI data, and there's so much talk about what the Fed is going to do. And some people are placing bets that the Fed is going to sort of reverse course here, or become more dovish, or, de-escalate the rate of the interest rate hikes. That didn't make any sense. You guys know what I'm trying to say here, though. Are these things possible? I want to read you one line. This is from a CNN article, but it says that the Fed briefly excited investors last week when it acknowledged in its policy statement it would consider the lag effects of all of its interest rate hikes on the economy before considering what to do next. And this is what I'm trying to keep in mind. These interest rate hikes that we had for October and September and even August, I don't think they've necessarily affected the markets yet to to how much potentially they could affect the markets. And the Fed talks about this, right? They want to see what the inflation data looks like before they give a lot of any sort of forward guidance on what they plan to do for December. And like I said earlier, if inflation comes in real hot, which the Cleveland Fed expects it to, then you can expect Jerome Powell to go 75 basis points at least, if not more. And is the terminal rate going to be 5%, 5.5%, 6%? I mean, they keep raising it. Who knows? Maybe they'll go lower than 5% so that they can, the long-term goal may be negative rates to get cash out of the system, get us over to this more cashless-based society, and to they tried to do it before. They wanted to do it. Trump wanted to do it too. Trump was on Twitter, back in like 2017, 18, talking about negative interest rates. So it's something maybe in the future they want to do. But for now, I mean, they're going to, if they want to crash the economy, if the inflation doesn't come down and they want to crash the economy, they want to put us in recession, that is exactly what they're going to do. And there's no way we can really fight it. So I don't want to ramble too much here. I've just been thinking recently, it's like, the investing is fun. It's cool, but this short-term trading thing, I mean, with my account up 13% today, where else are you going to get a gain like that? A 13% gain in your account, within moments. It's not going to happen investing. So I will continue to play these short-term trades. I'm looking for the quickest opportunities. It's like a heist. I'm trying to get in and out, right? I'm trying to get in as quick as I can to the bank, hold them up for as long as my nerves will let me stay there, and then I want to get the hell out before the sirens turn on and all the police get there and they take all my money away. So very dangerous game, but it is exciting. I cannot wait to see what happens over the election here, which is tomorrow. I'm not going to say much on that, but hashtag Red Wave 2022. I'm just kidding, Dems. So yeah, with that, I will see you guys on the next video. Make sure to give it a like and comment down below if you're watching anything that I didn't talk about.